You do not have a money problem. You have a trap problem, and the trap was built long before you graduated, long before AI started gutting entry-level jobs, and long before your paycheck stopped keeping up with the real cost of living. Here is what nobody says out loud because saying it would require admitting the system was designed, not discovered. Banks do not make money by being your friend. They make money by owning your future cash flow. And in 2026, after years of rate swings, housing lock-in, and institutional control of everything from student debt to crypto, the trap is tighter than it has ever been. This is not financial advice. This is financial education. If you are anxious right now, good. Fear means your brain is finally waking up. Let's talk about how the debt machine works, why the rules feel personal but are not, and how you can stop treating debt like a personal failure and start treating it like a transferable weapon. In 2026, the average person has three problems that rhyme with each other. Wages feel stuck while prices never really return to 2019. Rent eats your monthly breathing room like a slow leak. And AI keeps shaving off the jobs that used to rescue people after one bad quarter, one layoff, one medical bill, one broken car. And then you are told the solution. Work harder, get more skills, go to school, use credit responsibly, buy a home when you are ready, invest for the long term. The problem is not that these instructions are wrong, the problem is that they are incomplete. They leave out who profits from you following them. You were taught to think money is a moral score, spend less, save more, be disciplined. But the debt trap does not care how disciplined you are. It cares whether you have a paycheck, whether you sign, and whether you keep paying even when your life gets smaller. Now imagine a simple illustration in your mind. On top are people who borrow at low cost, often secured by assets they already own. On the bottom are people who borrow at high cost, secured by income they cannot replace quickly. That spread is the difference between the rich and everyone else. And in 2026, that spread is being protected by regulation, by risk scoring, and by technology that makes approvals faster for insiders and stricter for everyone else. They call it access. You should call it control. First, let's start with the most basic mechanism, because it is the foundation for everything that follows. Banks do not wake up and decide to be generous. Banks are not charities. They are factories for interest. Suppose you deposit $1 million into a bank. The bank pays you a fraction of that back, maybe around 2% in a simplified world where rates are high and depositors get something. So you earn $20,000. Now someone else borrows that same money. That borrower pays the bank maybe 10%, or in a real-world range sometimes more, depending on credit score, collateral, and the product. If that borrower pays $100,000 in interest, the bank pockets the difference, the spread between what it pays depositors and what it charges borrowers. That difference is not a side effect, it is the business model. Banks exist to harvest the gap, and the key question becomes this: how do banks create borrowers? Because you do not accidentally walk into a bank, you are steered, you are encouraged, you are pressured, you are offered credit when you are vulnerable. You are told it is normal, safe, and smart. You are shown the lifestyle first, and you meet the bill after. They sell you the entry point, and once you are inside, they sell you the continuation. And here is the part nobody wants to say out loud: the most profitable borrower is not the one who can pay easily. The most profitable borrower is the one who has to pay no matter what, the one whose job can be automated, the one whose rent keeps rising, the one whose insurance premium just jumped again after a wildfire year, the one whose local clinic is booked out for months, the one who has family obligations and zero bargaining power. That kind of borrower does not need a convincing advertisement, they need a timing strategy. In 2026, the timing strategy is getting more aggressive because the environment is worse. Global debt has exceeded $300 trillion. That is not a headline for your screen. That is a structural reason why lenders behave like lenders and not like partners. When systems are stressed, the safe cash flows get prioritized, and consumer debt, housing debt, and credit products become the most reliable revenue streams. But you might say, okay, so banks profit from debt. Everyone knows that. The deeper trap is that the debt is not just debt. It is a funnel that selects your future behavior. And we need to talk about why the funnel is so effective right now, in the era of AI. Because AI is replacing tasks, not just jobs. And the people who lose tasks lose bargaining power. When your income becomes less secure, interest rates feel like a permanent tax. Your life becomes a negotiation with minimum payments. Pattern interrupt. Picture a 32-year-old nurse named David. He did not chase glamour. He worked nights, picked up overtime, and kept his head down. In 2020, he took a second job to offset rising costs. He did it while everyone online insisted that skills would protect him. But AI did not replace him directly. It replaced the billing workflows and part of the scheduling process. The hospital reduced administrative staff. Then the overtime budget shrank. Then his landlord raised rent after a county insurance shock. David still has student loans. He took them for stability, then he took them again for career upgrades. Now he is facing an emergency expense, a broken car, and a family medical bill. He does not have a cash buffer because his purchasing power is gone. So he uses credit, and that credit becomes a monthly obligation. He is not stupid, he is not irresponsible, he is reacting to pressure. That is exactly what the debt funnel depends on. And there is another layer nobody talks about. Many lenders profit from your emotional fatigue. When you feel behind, you stop comparing the deal, you stop checking the terms, you stop planning, you just try to stop the bleeding for this month. So you pay. You pay late sometimes, you pay fees, you get reassessed, your credit score changes, the rate changes, the bank has not changed, you have become a repeat customer. Now the next question is the one you should have asked years ago. Why did so many people treat education like a guaranteed ladder? Because the ladder was not built for you. It was built for the system that securitizes your future. After the 2008 financial crisis, the United States expanded and reconfigured financial products to keep credit markets alive. Housing risk was contained through tighter underwriting and insurance requirements, but there was still a need for high-quality long-term cash flows. Student loans became a reliable pipeline. By the time more Americans realized what was happening, the loans were already packaged, serviced, and traded in ways that turned personal struggle into institutional revenue. Over time, student debt and credit card debt grew into large, durable pools of assets. And in 2018, student loan balances reached levels so massive that they were not just consumer liabilities anymore. They became central holdings in the financial ecosystem. So yes, education matters. But the promise you were sold was a guarantee of upward mobility that the data does not support for everyone equally. A degree can raise your ceiling. It can also lock you into decades of interest payments, especially when your starting wages are delayed by an AI-driven hiring shift and a tight labor market that favors experience over potential. Let me put it plainly. You were pushed to borrow for time. You were borrowing years of income. You were trading youthful flexibility for immediate credibility. And when AI accelerates, that credibility may not pay fast enough. When the job you trained for gets redesigned into a different workflow, your repayment schedule does not get redesigned. Your bill is fixed. Your income is not. That is the trap. Debt is rigid. Life is not. So you graduate, you start working, you pay, you think you are doing the right thing. Then you realize something terrifying. Your money is not building freedom. It is building someone else's certainty. Now we move to the next funnel, and this is where the story gets ugly. Pattern interrupt. Think about the moment you turn 18. You do not feel dangerous. You feel excited. You are starting adulthood. Then you see the mail offers. Credit cards, pre-approved. The interest rate is there in fine print. The fees are there, but the message is simple. You can have things now, pay later, and the bank counts on one human weakness more than any other. You want the feeling of progress. A card makes you feel like you are buying forward, like you are not stuck. The bank also counts on your life events: marriage, housing, holidays, a car purchase, a move to a new city because your job vanished where you were, a family emergency. The bank does not care why you borrow, it cares that you keep paying interest. That is why credit card systems are built to keep balances alive, because balances are how the bank captures compounding. People like to argue that if you pay in full every month, credit cards are fine. In a fantasy world, yes. In real life, people miss payments. Real life is not a spreadsheet. Real life includes illness, layoffs, and unexpected costs that eat your month before you even know they exist. And in 2026, those unexpected costs are everywhere. Insurance premiums are rising in areas exposed to climate-driven disasters. Repair costs are increasing because supply chains still wobble. Utility bills creep up while landlords add fees that never existed before. So the credit card balance grows, and the bank's interest grows with it. They call it your responsibility. But responsibility is not the issue. The issue is that the system monetizes your vulnerability. Now here is where you should feel anger, controlled, and precise. They knew the structure would keep you paying as long as you stayed dependent. They built products that scale with your stress. They knew you would chase the dream. And they made sure the dream required debt. Cliffhanger. And once you have student debt and credit card debt, you do not stop. You shift to the next trap, the one that feels like adulthood and stability. Housing. Everyone thinks housing is the safety net. Housing is the anchor. Let's talk about the housing affordability crisis in the United States, the United Kingdom, Canada, and Australia. In 2019, your wages could roughly match rent growth. In 2021 and 2022, inflation and supply issues drove prices and rents higher. In 2023 and 2024, interest rate hikes pushed mortgage affordability down. In 2025 and into 2026, wages did not fully catch up to what housing costs demanded. So the story becomes this. You either buy with a large monthly payment that stretches you thin, or you rent and watch your rent rise while you build no equity. Either way, cash flow is attacked. But the banks designed a system where both paths feed the same machine. They tell you to buy because prices will always recover. They tell you to rent when buying is too expensive. But even renting is not neutral. Rent reflects the same inflation pressures, the same insurance pressures, and in many cities, the same investor demand that pushes prices higher. And if you do buy, the mortgage becomes a long-term contract that transfers wealth, not creates it. Here is the mechanism again, but with a mortgage example. Suppose you buy a home for $1 million. You put down $300,000 and borrow $700,000. Your monthly payment may be around $3,000 depending on interest rates and term. Now you rent the place for $2,500 a month. You might think the difference matters, but a mortgage payment is not one thing. It is principal plus interest. In the early years, interest is a larger share. The principal grows slowly. So if your rent is below your payment, you pay out of pocket. So is that a bad deal? If you are measuring it like a normal person, yes, because it looks like a monthly loss. But the trap teaches you to obsess over monthly cash flow and ignore long-term structure. The more profitable view is that the principal portion of your mortgage payment is building equity that you can recapture when you sell. Meanwhile, interest is the cost of capital. Equity growth and recapture become the lever. Now the darker truth. For people who buy as their only wealth strategy, not as part of an engineered asset plan, the reality is brutal. If home prices stall or decline in a local area, they may be forced to keep paying while equity shrinks, and if they lose income, the risk becomes immediate. In 2026, underwriting is stricter than the old fantasy. Banks check income, debt-to-income ratios, and collateral. Down payments are higher in many cases, and if you cannot pay, you do not walk away safely. You can get trapped in penalties, foreclosure processes, credit damage, and a ruined credit score that makes everything more expensive. Yet the system still pushes the buy-or-bust logic because it is profitable for originators and investors. Mortgage-backed assets are part of the capital markets ecosystem. The bank's risk is not your risk alone. It is distributed, hedged, and priced into the product. So the bank can keep offering mortgages even when the borrower is stretched, as long as the underwriting gate filters enough people to maintain portfolio quality. But what happens when the environment shifts? When job losses rise due to AI disruption? When insurance markets collapse and homeowners face sudden policy increases? When migration costs force families to relocate? In those cases, the debt becomes a lifestyle tax. Now I want you to remember something about human psychology. People will rationalize nearly anything to avoid admitting they were trapped. If you bought a home and rates rise, you tell yourself it will be fine. If you are renting and prices keep going up, you tell yourself you are building stability. If you are using credit cards and interest is climbing, you tell yourself you will catch up after one bonus. You keep justifying because acknowledging the truth would mean admitting you made a deal under unequal conditions. They designed the unequal conditions. Now the next layer is the part that makes your stomach drop, because it connects debt to the feeling of financial identity. For years you were taught that poor people are poor because of bad choices. Rich people are rich because of discipline. But that story breaks the moment you look at balance sheets. People say, do not carry liabilities. People say, pay off your debt. Sometimes that is good advice. But the system does something more sophisticated. It classifies debt as if it is always poison. That is not accurate. Debt can be a tool, but only if you can control the asset side of the equation. So the real educational gap is this. You were never taught how to read the balance sheet, not the way schools teach it, but the way the wealthy actually think. Income is what hits your bank account every month. Expenses are what leaves. That is the budget story. But wealth is the balance sheet story. Assets and liabilities. The asset side creates future income. The liability side consumes future cash flow, and the wealthy are obsessed with the asset side because the asset side is what makes your monthly life less dependent on employment. In school, they teach you to manage a monthly income statement. The wealthy manage the balance sheet and the cash flow timing. This is why the same person can work a job and still become richer. It sounds impossible until you see what is happening in the background. Imagine two people. One earns $50,000 a year and spends $45,000. If they have debt, their budget is tight. One missed paycheck and they fall behind. The other person earns $50,000 too, but they have an asset that throws off cash. Not a hype asset, not a lottery ticket, an asset that generates recurring income. Their job becomes supplemental. Their debt becomes manageable because the cash flow from assets fills the gap. That is the difference. Not work ethic, not intelligence, cash flow ownership. Now, in 2026, AI changes this again. Because AI makes it easier to generate content, easier to run small businesses, and easier to automate workflows. That sounds empowering. It also sounds like a path out. But social media sells you the dream of passive income as if it is an ATM that prints money with no maintenance. Meanwhile, most people building creator channels earn almost nothing. Most content does not monetize. Most side hustles fail. The average viewer sees highlight reels and forgets the months of unpaid labor. And while you are dreaming, large institutions are capturing the real advantage. They buy distribution, they buy audience data, they buy the infrastructure, they own the platforms, they turn your attention into a microtransaction supply chain they manage with algorithms. So even the creator economy is not a pure freedom story anymore. Many creators are dependent on platform rules and ad revenue cycles. One policy change and their income collapses. So what is the actual playbook? It is still about assets and cash flow, but you need a rational way to build them that survives reality. Cliffhanger. And there is a final trap on top of the loan traps and the credit traps and the housing traps, and it is the one that keeps people hopeless long enough to keep paying. Think about retirement. In 2026, retirement is not just a personal planning issue, it is a structural crisis. Social Security is under pressure due to aging populations in the United States and Europe. Pension funds are strained by market volatility and underfunding. Many companies have shifted risk to employees through defined contribution plans rather than defined benefit plans. At the same time, the cost of healthcare rises with age. Insurance costs rise due to climate risk and market concentration. And AI is accelerating productivity gains while reducing the number of mid-career roles that used to provide stable contributions to retirement accounts. So